All right, so let's begin the show. And today we have Meet Your Fund Manager segment where the fund category in focus is a multi-cap category and the fund in focus is Mirae Asset Multicap Fund. With me, I have Ankit Jain, Fund Manager, Mirae Asset Investment Managers India. Ankit, good evening and welcome to the Money Show. We'll be talking about your multi-cap fund. But before that, let's get an overview of the performance of multi-cap category this entire calendar year where we've seen mid-cap and small-cap beating the large caps, Nifty small cap going above 40% return, Nifty mid cap giving almost around 38% return. When it comes to funds, we've seen mid cap and small cap beyond 30% almost. So when it comes to a category like a multi-cap where you have a similar or uniform market cap exposure, what kind of a performance can one expect? How has the year been for this entire category, Ankit?
Yeah, hi, good evening. So yes, you are right. I mean, if you look into multi-cap as a category, clearly, I think good mix of large, mid and small cap. And since mid and small cap by TD has relatively outperformed by almost 28% large cap, right? So to that extent, blended average of return of this category also has been, I think, fairly good. And that is what, I think is pretty exciting about this category also, right? Over longer term, that with good mix of large cap, which is typically in any mandate, in any multi-cap mandate is around 45 odd percent, with I think 55% coming from, let's say, mid and small cap category. I think good blend of these two do offer a, I think, unique combination in terms of long-term better risk-adjusted return for the category.
All right, Ankit, let's understand your sector exposure. And talking about a multi-cap fund, we will also later on compare it with the flexi cap in the interaction. But then I want to understand your sector exposure when it comes to across market caps, large, mid and small.
Yeah, so if we look into our sort of a market cap allocation in this fund is large cap is around 41-42%, and then mid and small cap is around 28% each. As far as sectorally allocation goes, I think we have been positive on financials, consumer discretionary, autos, healthcare, utilities, and some of the new age businesses, right? While we are underweight on, let's say, IT, FMCG, capital goods, I think some of these sectors we have been underweight. So clearly, as things stand today, I think we have tilted our portfolio more large cap bias within whatever flexibility we are having by managing the mandate, because we believe that valuations are relatively more reasonable out there versus mid and small cap, where we have seen, I think, pretty good rally. And I think valuation in historical context is slightly on the higher side.
Ankit, I also want to understand your sector liking specifically in mid cap and small cap.
Yeah, so if you look into mid cap and small cap, do offer, I think, very wide variety of sector choices. And I think quite a lot of different sub-segments are there, and that is how I think bottom-up stock picking is even that much more important. But having said that, I think we have been able to pick and choose businesses across different various sectors. Right from auto ancillaries, and then maybe some of the IT, IT small cap name. In addition, I think incrementally we have been more positive on, let's say, cement and actually logistics as a sector, and we are finding, I think, relatively more opportunities in some of these names, particularly in the small cap area.
Ankit, I really want to understand the kind of sectors you are currently underweight on, but then in coming quarters, you might just want to increase your exposure.
Yeah, so see, sectors like IT, we have been a bit underweight. As of now, clearly given, I think, globally very high interest rate scenario, I think depressed bit of a demand outlook in the near term. But having said that, I think Indian companies time and again has exhibit pretty resilient, I think, business model, and have been able to grow, I think, consistently along with pretty good cash flow conversion. So to that extent, I think, in case if you look into now interest rate outlook globally, it looks like might have plateaued out. At least interest rate hikes, hopefully, at the margin, maybe demand visibility might also start improving in that backdrop needs to be tracked, and IT sector may be underweight stance as of now might get reviewed in maybe future.
So, Ankit, I also want to understand now, talking about a multi-cap category, I think your fund was just launched in August. Since there are already existing fund of this category and you've just entered, what's going to be your strategy to beat not only the benchmark but also be the best performer in the category?
Yeah. So it is all about, I think, fund investment philosophy and typically how do we go about pick and choose businesses on bottom of stock selection basis. Typically top down at a sectoral level, our philosophy always remains to build a risk-adjusted portfolio, risk-adjusted diversified portfolio across different sectors. And then within that, try to pick and choose, I think, stocks which do offer better risk-adjusted return over longer time horizon. So I think with this sort of a construct, we have gone about building the portfolio, and we continue to believe. I think this remains the key sort of a bedrock. As far as the outperformance goes in the future, hopefully.
So now tell me one thing. Now, considering this entire category and the way it's performed, if I really want to diversify my portfolio, this is a great category to have. But then if I already have a large and mid-cap and small cap fund in my portfolio, how will a multi-cap add to my profit?
Yeah, no, so this is, I think, single category where I think pretty good combination of large, mid, and small gets clubbed under single product. So to that extent, I think for any average, I think investor with slightly higher sort of risk, risk appetite, I think this single product do cater. I think need to almost what he would basically someone would like to have from the longer term standpoint, right? So and also I think we as a fund manager has got limited flexibility while managing this particular category because it is a very well defined, right? 25% each minimum has to be maintained in all of these three segments of the market, large, mid, and small, and then flexibility is only to the tune of remaining 25%. So I think a good blend of large, which is around 40-45% at any given point in time, do offer pretty good stability to the portfolio. At the same time, I think good allocation towards mid and small up to maybe 55-60% do provide the desired alpha over longer time horizon.
Right. Going ahead, Ankit, what is your sense of the market also? Specifically talking about large cap, do you think the large cap story is going to be back?
Yeah, no, so the good part has been that earnings growth has been fairly resilient and which is providing good support to the market apart from maybe flows and liquidity. I think that is also adding to the buoyant market. However, one has to understand that a large part of this earning growth is also backed by, I think, good margin expansion benefit because of, I think, fairly benign commodity price environment. And while at the same time, I think top line growth has not been that broad based. We have seen certain sectors firing well in terms of top line growth, but on the other hand, I think some of the other sectors has not been doing that great. So I think going forward, I think earnings growth outlook remains good, maybe mid-teen sort of a CAGR. Across maybe large cap, maybe low teens, maybe mid and small cap, mid-teen. But needs to be seen in the context of some of the headwinds also, right? Maybe globally things are still a bit volatile, might be improving at the margin. And some of the maybe front loading of capex might have happened into certain sectors. So I think given very sharp relative outperformance of mid and small cap, relatively, I think it is good time to really, I think allocate incrementally more money towards large cap, at least from the near-term standpoint. But overall, I think from longer-term standpoint, we continue to remain fairly constructive on the market, despite of valuations being at a premium versus historical average, because some of this is being backed by, I think, pretty good, strong, strong earnings outlook. And good part has been that quarter after quarter earnings are not getting downgraded, which used to be case earlier, right? So as of now, at least earnings at a blended level are sort of holding up, which is providing support to the market. So I think longer term, we do remain fairly constructive on the market.
Interesting. Thank you so much, Ankit Jain, for being on the show today and helping our viewers understand about the multi-cap category and your specific fund. Time to slip into a quick break, but then before I slip into a break, I would want to leave our viewers with our WhatsApp number and our email ID where we keep waiting for your queries. 8657974571 is our exclusive WhatsApp number where you can send us your questions. And the money show at etnow.tv is the email ID where you can send us your queries as well. And once you send your queries, we will have your questions answered by our experts live on the show. See you after the break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and there are a plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? Today I have with me Hemant Stiggi, Wise Invest. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 8657974571. You can also email us your questions on the money show at etnow.tv. Hi, good evening, Hemant, and welcome to the show. And before we take on our viewer queries, let's discuss about the 250 rupees SIP, which is under proposal by SEBI. A great move in order to increase participation and to help people, come into equity markets. But we also have 100 rupees SIPs going on in specific funds. And thanks to the digital progress that we've been seeing, so many platforms, in just one click, you can buy a mutual fund. But an interesting way to have 250 rupees SIPs now?
Oh, yes, Kavita, I totally agree with you. I think what we have seen over the last few years, how SIP has allowed lakhs of investors in our country to invest in market-linked product through the mutual funds. And now we are seeing that our SIP book is more than 70,000 crore. So obviously, we've always been talking about having the equity cult in our country, and I think SIP has ensure that slowly and steadily we get there. I think this step of allowing SIP of rupees 250, I think is a great step. It will allow almost every investor in the country to start investing in mutual funds. And I think the important thing is that the biggest fear that every investor has is that they always think that I don't have so much money to invest. If it's a large money, I think that fear will go away. And second is the fear is also of volatility. So once they start investing, they spend some time. They will understand equity as an asset class. They will maybe keep increasing their allocation to that. And I think the way we have seen how SIP has allowed investors in India to build wealth, you will see more and more investors in our country building wealth through this. As you rightly mentioned, I think some of the funds are already doing 100 rupees SIP. I think this will allow kind of industry to take a decision at the industry level, and SEBI will kind of trying to ensure that. And once that happens, every fund will have SIP of 250, which means that investor will have a wider choice as compared to today, where there are only few funds that are offering 100 rupees SIP. But I think it may not go down to obviously 100 at this level for the industry because there are certain costs involved, and obviously there are certain other aspects that have to be looked at. But I think bringing it down to 50 as the minimum amount is I think is a great step.
Point of view, it's a great step, but then as far as the industry point of view is concerned, do you think they'll be able to manage the cost with 250?
Well, it's going to be a bit challenging, Kavita, let me say that. But I think what you will see that, what we are seeing also even in the rural, semi-urban areas, okay, the way people are comfortable with digital. And I think most of it should happen through that. Maybe over a period of time, you'll see other channels kind of becoming active in that space. But initially, you will see that maybe getting restricted to that. And obviously, there will be small investors. What happens is, it's not that somebody who's starting at 250 will remain at 250. You would definitely expect them to increase the size. So all the distributors, mutual funds, he may like to kind of include them in their process. Slowly, maybe the amount will increase. At this point in time, the costs can be a little prohibitive. But I think over a period of time, as the size of investment will grow, as more and more investors will use digital to kind of start investing in mutual funds, the cost, I think, to an extent can be handled.
Also, just a small calculation, if you start your SIP of 250 rupees every month, we want to become a crorepati, how many years would it take?
Well, if I assume a return of 12%, it's going to take around 50 years. Obviously, when you invest for 50 years, two important aspects, like I mentioned, that you're not going to be continuing investing 250, maybe you'll increase investment over time. And, in all probability, I think the returns are going to be much higher than 12%. But since we are trying to kind of project how much investors can expect and how much time it will take, it's better to be a little conservative. Yes, it will take around 50 years. For 50, like it will take 44, and for 25, like it will take around 39 years.
To really be careful of, it's okay to start with 250 rupees, but then you also have to make sure that you increase your SIP amount, because 1 crores in 50 years would mean how much?
Well, I agree that if you look at inflation over the next 50 years, obviously, it may not be amount, because, there are a number of times when we talk about investors wanting to become a crorepati. The fact is that even if you become crorepati, it does not take care of all your needs. But again, like I said, I think the issue is, how do you ensure that more and more people start investing in market-linked product? How do they create wealth through the stock market or different asset classes? So I think in that direction, it's an important step. I agree with you that, by just investing 250, even if you become 1 crore, it may not be enough at that time to take care of all your needs. But like I mentioned earlier, my belief is that once that fear of investing into market-linked product goes away, you definitely will expect, one, the base to become wider, and of course, investors to start investing more and more. And we always talk about step up SIP, and it's a magical thing, because it gives you compounding, and it allows you to build a much larger corpus. So I believe that once they begin investing, small investors begin with amount as little as 250, they will increase the amount, they'll become comfortable with the asset class, and they'll be able to build much larger corpus. And as I mentioned earlier, that the returns you can be expected realistically to be more than 12%. So maybe it will not obviously take 50 years to get there.
That will be all the magic of SIPs, and under proposal rupees 250 SIP. But having said that, it's very important for you to not only just start investing via SIP, if that's the route you want to opt for. It's also important to step up your SIP. Hemant, let's move on to our viewer queries, and let's take Vinay's question from Mumbai. It's via email, and he has started investing in mutual funds, and he wants to know if any changes are required. It's ICICI Pru, World Discovery Fund, HDFC Top 100, Invesco India Contra, Motilal Oswal Flexi Cap, Axis Small Cap, Motilal Oswal Small Cap, Nippon India Small Cap, SBI Large and Mid Cap. These are the funds in which he's doing SIP, some 2,000 and some 1,000 rupees.
Well, Kavita is currently investing around 11,000. I think he has around 8 funds in his portfolio. So clearly it's a case where you see over diversification in the portfolio. And second is, he hasn't mentioned his time horizon. Considering the fact that he's investing all his money into equity fund, I'm assuming that the intent here is to invest for a longer term and build wealth. So if that is the case, he can obviously continue investing in equity fund. But like I mentioned, there is definitely a case to consolidate the portfolio and reduce the number of funds. So my recommendation would be that out of the existing funds, HDFC Top 100, he's investing at 1,000. He can increase that amount to 3,000. Then he can retain one small cap fund, which is Nippon Small Cap Fund, where he's investing 2,000. And the remaining 6,000, my recommendation is to add 2 new funds as against all other existing fund. One is a multi-cap fund, which is a Kotak multi-cap fund, where he can invest 3,000. And the second is a large and mid-cap category fund, which is Motilal Oswal Large and Mid, where he can invest 3,000. So in all 4 funds, it will become more compact. He will have the right kind of exposure to all 3 segments of the market, and I think the portfolio should be better.
All right, so that's the solution coming up for Vinay. We don't have him on the phone line. But let's move on to our next viewer from Jaipur, Anuj. He says he's 34 years old, and he's been investing in NPS and corporate group funds, especially the SBI pension fund and life cycle. That's the choice in it. And he wants to understand if he can change this scheme and he can switch into a corporate group fund and better investment as compared to an NPS. What would that be?
Well, I think he's mentioned that he's in life cycle fund. Obviously, there are 3 options. He hasn't mentioned which one he has. There is LC75, there is LC50, and there is LC25, which basically tells you how much maximum exposure you can have in equity. Now, what happens in the life cycle, that till the age of 35, you have this maximum exposure. And thereafter, for example, if you look at aggressive, it starts coming down by 4% every year. So by the time you get to the age of 55, it comes down to 15%. considering that his age is 34, my belief is that since he's trying to build a corpus for the long term, he has enough time on hand. I think his focus should be primarily on equity and maybe some exposure to debt. So, my recommendation would be that he should move to equity asset class, wherein you can invest as much as 75% and keep it there till 50 years. And thereafter, it goes down by 2.5%. And by the time you're 60, your equity exposure is 50. So I think that will be better for him in terms of asset allocation point of view. Yes, I mean, if he's in the corporate plan, if he wants to change his scheme, he can do that. Now, there are two ways. Sometimes what happens, the employer, right from the beginning, allows the employee to change the investment plans. If that's the case, it can be done. If not, he can, log into his personal account, and his employer will have to kind of, allow him to change the scheme. So definitely he can do that, even though he's in a corporate plan. Like I mentioned earlier, my recommendation is that he should go into equity asset class.
All right, I think that will be all. Thank you so much, Evan, for being on the show and helping our viewers with their mutual fund portfolio queries. And with that, it's a wrap. I'm going to leave you with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.